very much for coming before us this morning. As you probably know from experience, the acoustics of the old part of Parliament's not quite as good as the rest, so we'll be particularly grateful if you can speak up for us, and I hope that you can hear us, Charlie.
Yes.
Can you hear
we
what's
can
going on
fine,
at the moment?
thank you. Just.
You can hear. Only just. Okay. Perhaps I can begin with a question to you, Mr. Bean. What do you think the essential ingredients of a banking union are, and have we got one at the moment in the Eurozone?
Okay, I think I would identify 5 components. The first is a common supervisory mechanism, regulatory arrangements, which obviously there's discussion taking place at the moment between members of the Eurozone and some other countries for that matter on how to set that up and operate it, and they're some way down that road.
That's a necessary condition.
I think so. So obviously when you ask about what's necessary for a banking union, I'm assuming you mean a banking union which we think is durable and works reasonably well. Some of the items I'm going to give you, you may not have, in which case you run more risks that the banking union may not function well.
I'm just trying to check that we're not talking about what's desirable, we're talking about what's essential.
I think they are sensible ingredients to create for a durable
I'd like to talk
banking
about what's essential for a durable banking union.
Yes. Yeah.
Only that.
Yeah.
And
Okay.
we need a single supervisory
Single
mechanism.
supervisory.
Have we got it at the moment?
No. As I say, that is the thing that the primary discussion within the Eurozone is about. The plan is to have something in operation probably towards the end of this year, beginning of next year, with the ECB taking the primary role in supervising systemically important financial institutions.
Okay.
Okay.
You've got 4 more.
Okay, so the second thing I would say you want, and the next 4 are all going to be dealing with what happens when things go wrong. So the second one would be a supplier of liquidity to banks which get into difficulty, a lender of last resort. And that clearly you do have in the form of the European Central Bank and the constituent national central bank. So that's in existence.
But what about the transfer of losses? What happens on the fiscal side?
Well, let me just go through the list, and I think you'll see how everything fits together. As far as lender of last resort goes, central banks, when they're providing support, lend against collateral, so there shouldn't be any losses associated with that.
So before we go any further, what do you think about the quality of this collateral across the Eurozone at the moment? Have you got any views about the quality of that collateral?
Well, I think it's reasonable to think that the collateral has certainly been impaired, say in the periphery countries, and that is an issue that obviously that a central bank always has to take on board when it decides whether to provide support to a bank that's in difficulty. Essentially, will it get its money back? And inevitably that collateral, as I say, is going to be impaired in some countries at the current juncture.
So that's the lender of last resort.
Lender of last resort. The third ingredient would be a suitable resolution regime for handling failing banks, winding them down, restructuring them, or whatever. Now that the Financial Stability Board has identified key attributes that you want in a good resolution regime. I think it's fair to say, although Paul may correct me because he knows more about this than I do, is that it's not true to say that all countries in the Eurozone presently have resolution regimes which are consistent with those key attributes, but they are in the process of implementing them.
So just to be clear, we haven't got that either yet?
Not yet, no, but that is sort of in train.
So far 3 essential ingredients, none of them in place.
No, the lender of last resort is.
Well, but you,
No,
you haven't explained how this collateral is going to be made effective in the periphery.
Well, I mean, that's not a problem about the lender of last resort not being...
Who's going to pick up who's going to pick up the tab?
Okay,
Mr.
let me get to that bit in a
Okay.
minute. The final two, I think, do connect with your concerns. So the fourth item that I would identify is common deposit insurance. And here you may need the ability to bring in funds from outside a country. So a country which is in fiscal difficulty may not have the wherewithal to provide the support to depositors unless the deposit scheme has been pre-funded.
I'm sorry to keep interrupting,
Yes.
but just for clarity, I mean,
Yes.
there's only questions for clarification. What we're really talking about here is northern tier countries insuring Greek bank deposits.
In all likelihood, yes, or Cypriot bank deposits, or whatever it may be. I mean, if the liabilities associated with the banking system exceed the capacity of the government to pay them, to make the deposit insurance scheme credible, and therefore discourage depositors from withdrawing their money, that people need to think there's a backstop there, which in this case, as you say, would need to be probably the northern countries. The final ingredient would be a mechanism for injecting fresh capital into banks that have failed and need recapitalisation. And just as with the deposit insurance scheme, you may need a source of funds outside for that if the country in question is in fiscal difficulties.
Okay, have we got that?
No, certainly not. At the
Right.
moment.
No,
Well, although there is
Okay.
the suggestion that the European stability mechanism should be able to provide that in the future. Government, particularly like Germany, have been keen that those injections shouldn't take place until other elements of a banking union, like the supervisory scheme, were in force. So we're short of that at the moment, but in principle you have a facility that could provide that.
The one item that was identified in a recent IMF report on this subject, which you've not mentioned, is a common macroprudential regime. So you're thinking of that as something that's perhaps desirable but not essential?
Certainly think, the way I would think about a banking union is to do with the micro supervision, the micro arrangements for the banking system. A macroprudential overlay would be highly desirable. The idea of macroprudential policies, it takes on board systemic financial concerns.
So
but it's not something I would regard as being
essential.
de rigueur. Desirable, but not de rigueur.
So what we've got here is 5 essential requirements, of which 4.5 are missing.
Well, I'm not sure I'd say the half. I think the lender
Of
last
which
resort...
4 are not yet in place.
Not yet fully in place. Some of them are in progress, but clearly well short.
So when Mario Draghi says he'll do whatever it takes to protect the Eurozone, there's a touch of the wing and the prayer here, isn't there?
Well,
Since he hasn't got any tools.
Well, I mean, his comment was particularly in connection with the heightened concerns in financial markets that some countries would leave the Eurozone, so that you were getting what's referred to as redenomination risk into those countries' bond yields, because if, say, a country like Greece exited, it would be highly likely that the new currency there would depreciate sharply, and that extra premium would be built into the associated bond yields. And Mario's remarks back in the middle of last summer were particularly directed at saying the euro is for keeps, we will do what is necessary to take that redenomination risk off the table.
Do you think that a banking union is an essential part of bringing stability to the Eurozone?
I think it's desirable. Where we are at the moment,
But not essential. Do you
well,
think that the Eurozone could be stabilised without a banking union?
Well, I would say it is very highly desirable. It will make it much easier to stabilise it. And the reason for that is that there is a strong symbiotic relationship between the fiscal position of the periphery countries and the position of the banking systems, so that the banks often hold a lot of the sovereign debt of those countries. So if the sovereign goes bust, those banks go bust. And equally, if the banks get into trouble, the sovereign has to provide the extra capital and so forth to restart the banking system. And somehow or other you want to try and break that doom loop between the two of them. And one way of doing that is a banking union where there is the possibility of some injection of funds from outside that country.
You're saying it's very highly desirable but not essential that we have a banking union in order to stabilise the Eurozone?
Yes, very, very highly desirable.
Now, we're not members of the Eurozone, obviously, but the reason that I'm asking these questions is that the Bank of England has identified the Eurozone as a key risk to UK economic growth and recovery. And given what you've said here, that the banking union is highly desirable to stabilise the Eurozone, and that 4 of the 5 necessary ingredients for a banking union are missing. Despite your natural sunny disposition, Mr. Bean, not always in evidence from the Bank of England, you would have to come round to the view, wouldn't you, that you're a bit on the pessimistic side about its prospects?
Not necessarily, because as I've said, that, these countries are on the route to creating a banking union, that putting resolution regimes in place is going through. The supervisory mechanism, the discussions are taking place with the aim of putting that in place by the end of the year. So they're on track to do these things, and clearly the sooner it's done, the better.
It sounds like a race against time.
Well, the nature of the problems in the Eurozone is that these are not things which are going to be solved overnight. It is a long haul back. But the sooner the preconditions are put in place, the more likely we are to get out the other side without major disruption.
Now, the body language of your 3 colleagues, 2 in particular, have struck me while you've been giving your very straightforward answers, and I'd particularly like to give Mr. Tucker an opportunity to say something, since he's at least as responsible for this area as anybody else on the 4 of you. And there was a grimace at one point from Professor Miles, so I'm going to give him an opportunity, and then I'm going to pass. I'm going to pass the questioning to Andrew Ledson. But first, Mr. Tucker.
Charlie's summed it up. I think your line of questioning is over-pessimistic about the determination amongst these countries in the monetary union to develop banking union, and that is reflected in our view of the fact that threats from the euro area to the UK have receded somewhat. As Charlie said, and I would underline this, there is a directive in an advanced stage of preparation on resolution that so far is extremely good. It could get worse, but so far is it extremely good. They have announced that once they've got that through, and that applies to all 27 member states, including us, and I think the Chancellor talked to you about this in your other committee yesterday afternoon. Once they've got that through, they have said that they will launch proposals for a single resolution authority and so on for the banking union. Why do I emphasise that? Because all roads lead back to what happens when banks fail. And even with fiscal transfers, there are bank failures that would stretch the monetary union, just as bank failures here have stretched the fiscal position in this country. So a necessary condition for a successful monetary union is a banking union with a really good resolution regime. I mean, more broadly, I would say strategically, monetary union won't be sustainable in the very long run without a high degree of economic union. The reason I think the markets have taken some reassurance since the announcements about the banking union is that the markets take it as a signal that the members of the monetary union are prepared to take steps and more steps towards fiscal union.
Okay. David Miles.
I'm not sure, Chairman, what I was grimacing at.
Well then, if you're...
But
have you got something you particularly want to say?
Well, I do have one thought. I mean,
okay, otherwise we'll move on.
Well, let me say one thing very briefly. I mean, I do think this is a tall order. If it is the case, the banking union requires the provision sometimes of outside capital to the banks of one country from some central pool, and if it requires a single deposit protection scheme, which necessarily might involve big cross-border transfers of funds, I think that's a big ask.
Okay. What I have been trying to explore is the bank's overall view of the depth of risk associated with the Eurozone that you've identified in general terms in your quarterly reviews and in other publications and indeed in speeches. And I think we've got some feel for this, but I'm going to...
somewhat,
yeah.
but it's still there.
But I'm going to hand over to Andrew Les.
Mr Tucker, it does seem to me that it's extraordinarily complacent the way that the bank for the last couple of years has always had a sort of little rider with its inflation comments that this is all of course subject to the problems in the Eurozone which are not going away, and there has been a complete failure on the part of the bank to give any scenario analysis in spite of the attempts of this committee to persuade you to do so. And don't you think, a very direct question to you, you're saying that the Eurozone has gone off on the right path towards European Banking Union. Isn't it absolutely inconceivable that German taxpayers will truly undertake the deposit insurance for Greek depositors, or indeed the bailout of Spanish banks, should it come to that? Isn't it absolutely politically inconceivable? And isn't that the sort of analysis that you need to be doing as to how on earth they're going to make that happen? Isn't it the case that the European Banking Union is only limited to a single supervisor because that's the only bit of European Banking Union that is politically acceptable within the Eurozone?
Well, you're probably better equipped than me to make the political judgments about...
No, but the impact on the British economy is fundamental.
I'm going to answer your question. I think you're better equipped than me, probably, to make judgments about political preparedness in Germany. What I would observe is that they have already shown some willingness for transfer payments. How far that goes, who knows? I think on the banking union, they have announced that they are going to do more than the single supervisory mechanism. They are planning to introduce a resolution regime for the banking union, which will go further than the 27 member state thing. And what you say about the bank, I don't think, I mean, colleagues want to come in, I don't think at all we have been trying to hide the risks from the euro area. On the contrary, the Financial Policy Committee has taken a tough stand over the past year in saying to banks, you must build up your capital and your resilience against the tidal wave that may be coming our way from the euro area if it unravels, which looked to be a tangible probability in the middle of last year and somewhat beyond. As Monetary Policy Committee members, we have felt that can we put numbers on that and incorporate it in our fan charts? I think we would find that very hard to do. I think anybody would find that hard to do. And what we have been clear about is that we're not going to go for spurious accuracy in our forecasts. Rather, we're going to say this is a major threat. It isn't certain to crystallize, and we are doing things elsewhere with our regulatory instruments to try and protect the UK against those threats. I think that including numbers in the fan chart, I doubt whether they would have satisfied you because you just said we were making them up.
Okay, Mr McCafferty, what do you think about the argument that it's impossible to disalign the politics of the Eurozone with the economics of the Eurozone? I mean, arguably, the survival of the Eurozone is about politics, not economics, because it is whether there is the political will for the Northern European countries to bail out the Southern European. And in the end, if the markets push them to test that point, then we'll find out. But that has a very profound impact, doesn't it, on Britain's economy. We're already seeing that the strength of the euro is actually having a chilling effect on the Eurozone's economic recovery, which in itself has a chilling effect on the UK's economic recovery. Isn't it the case, therefore, that in this particular area, the Bank of England simply can't hide behind the fact that, oh, well, this is politics and we don't do politics?
I don't think we are hiding behind the fact that this is as much a political as an economic question. I think Paul's point about putting numbers to political questions is extremely difficult and is, as it were, at the extreme edge of the risk fan chart that we put around the central projections. But I do think that I would also agree with him that I think the risks of immediate breakup have receded over the course of this year as a result both of the actions of the ECB and of the manifest choices of the political parties and their electorates across Europe. It is clear that the German electorate has been more willing to countenance some fiscal transfers than was perhaps expected, certainly in this country, a year ago. And I think that does mean that the immediate risks of breakup have receded, albeit that, as we've seen overnight, politics is difficult to predict, and certainly with the case of the Italian election, and as a result, risks still remain.
Okay. So, Mr. Tucker, what analysis have you done on the politics, for example, the forthcoming election in Germany and the impact that that might have on policy that in turn affects the economy? What I'm trying to get at here is, to what extent can you simply say this is a major threat and leave it at that, but we're not going to put numbers on it because it's too difficult? Or to what extent does the bank feel it ought to have a contingency plan in case the politics overtakes the economics?
This idea that we have done nothing is nonsense with respect. We have been absolutely clear with the regulators that they need to ensure that the balance sheets of UK banks are strengthened to make them as resilient as they can be against an Armageddon in the euro area, without in the process making the path of recovery in this country worse. I mean, that is the, if the euro area falls apart, the most direct unpleasant channel to this country would be from a collapse of the euro area banking system cascading into the UK banking system. And the UK banking system has made itself somewhat more resilient, and we wait to hear from the regulators in March at the next FPC meeting. So I underline, I mean, if the premise of your question is we've said all this is terribly risky and we have done nothing, that couldn't be further from the truth. The other thing I would underline is that compared with 5 or 6 years ago, we have, where we would not, as an institution, have had the instruments to say to the regulators, you must do something about this. This is an example of the new regime announced in 2010 being used. On your question about the extent to which we follow the politics of this country, one of the things we have done, I've certainly been involved in leading this, as has Charlie, is make greater use of the Foreign Office than perhaps we were 5 or 6 years ago, to ensure that we can track the views of various different potential outcomes in these countries. But I don't think any of you, with respect, would be able to predict either the makeup of the German coalition, assuming there is a coalition after their election, or indeed the commitments that may be given during the election campaign in Germany. Do we think the German election will be tremendously important? Yeah, I think it will be very important indeed. I hope it gets the coverage that it warrants in the UK media.
Okay, Mr. Bean, one final question. Dr. Carney wrote to this committee saying that the bank will need to support the government as it engages in efforts of the euro area to refound the European Monetary Union. What do you think he means by that? How do you interpret that?
Well, I should imagine that he means by that we play a full part in the European fora in which we're represented, or where we interact with other European countries. So obviously the Financial Stability Board and the Basel Committee is one forum where we're represented, and we interact, and Paul can expand on that if necessary, but also in fora like informal ECOFIN meetings and things like that. So we're one of the people at the table, and we can encourage our European partners to move faster in what we think is the right direction.
And do you think he's right to be calling for increased German private sector wages to ease the balance of payments problem?
Well, I wasn't aware that Mark was had called for actions in other countries, so you'll excuse me if I'm not aware of that particular.
But is it appropriate for the central bank in one country to be calling for action to be taken in another country?
I mean, it is perfectly reasonable, I think, for people to point out the consequence of imbalances. I mean, we have imbalances at a global level between some of the emerging markets and the deficit countries like the United States and so on. And we have imbalances within the Eurozone. One of the problems if you focus excessively on austerity as the solution to the countries that are in deficit and have fiscal problems is you end up with insufficient demand overall. A sensible thing is for also to look for an increase in demand in the surplus countries that have got more room for manoeuvre. And there's various ways that you might decide to go about doing that. So I suspect the quote of Mark Carney's that you're citing there had something to do with the desirability of realising that you need a two-handed approach here to dealing with imbalances. It's not a case of putting all the weight on the deficit countries doing the adjustment. And that same argument applies at the global level, where the imbalances that we had before the crisis, which were partly drivers of that financial crisis, but those imbalances are still with us. They've narrowed to a degree, but that, in my view, largely reflects cyclical developments. And the fundamental problems still need to be addressed.
Can I add one thing, which is that in this world of a single supervisory mechanism centred on the ECB, we think that that provides a good basis for really good cooperation between the Bank of England as supervisor and the ECB as supervisor. Big picture, in the Western world, there are going to be four big supervisors: Federal Reserve, the ECB, Bank of England, and the Swiss. That is a somewhat simpler world than at the moment, and we also think that with supervision moving to the Bank of England and supervision in the banking union being centred on the ECB, that we will be able to draw on excellent relations with the ECB to improve supervisory cooperation. And Mark may have had that in mind too.
Before I pass the questioning on to John Mann, is there anything you want to add to that, Professor Miles?
Just one thing on the Eurozone situation. I mean, I think in some sense the risks of things going badly wrong in the Eurozone is absolutely crystallised. I mean, many of the economies are going backwards at a rate of knots. Overall growth in the Eurozone over the last year or so has been close to zero. So I don't think this is something that, well, it could go wrong. I mean, it has gone wrong. And I think the projections that we've made in the inflation report are really based on the assumption that growth remains very weak and anemic throughout the next few years.
And that is in the fan chart.
Yes.
It's the tidal wave Armageddon risk that isn't in the fan chart.
Okay. John Mann.
Thank you, Chairman. Mr. McCafferty, we've learnt that you're not a HoC and you're not a dove. I wondered whether you were a flexible inflation targeting man.
I'm an inflexible or a flexible?
Flexible.
Flexible. I think I, along with the rest of the committee, are flexible inflation targeters. I think the bank has, and the MPC, has been a flexible inflation targeter for since its inception in back 20 or nearly 20 years ago now. From that point of view, I think I would refer back to some comments that have been made in the past by both the current governor and the previous governor of the Bank of England. We have to deliver over the medium term a low and stable inflation rate, but at the same time we have to be mindful of the fact of causing undue volatility in output in the short term at the same time. I think I think the issues are probably more acute as we speak than they have been for much of the history of the MPC. The circumstances are more difficult. Both inflation and GDP growth are more volatile currently than they have been for much of that history. And as a result, I think the bank has had to exercise that flexibility probably more explicitly over the course of recent years than it perhaps did 5 and 10 years ago. But I think the bank has always seen the mandate as one in which it delivers stable inflation over the medium term, but without delivering undue volatility. And I think that, to me, is the definition of flexible inflation targeting.
You fitted into the MPC's consensus very quickly since your appointment. Before you were on, when I questioned the current governor at this committee, there was no ambiguity. When I raised precisely this issue, the current governor was adamant that there shouldn't be a flexibility. There was a target, and it was right that the target should be set. So there is a
target, and we are operating to that target. But the speed with which we bring inflation back to that target, and the time frame over which we bring inflation back to that target, provides an element of flexibility.
Are you in favour of German wages increasing?
It depends whether, for what reason German wages would be increasing. If they're increasing because German productivity has increased, then I think it would be a very good thing. If it were simply to introduce inflation into the system, then no, I wouldn't be.
And what's your attitude to the labour market constraints in this country? I mean, do you think that the labour market here is sufficiently flexible?
Sufficiently flexible for what purpose?
Sufficiently flexible for growth into the future?
Yes, I do. I think that in terms of the legislative and regulatory framework, I think we have a very flexible labour market. I think that's been demonstrated by the performance of the labour market over the course of the last decade or more. What I have suggested in my recent speech is that there may be some changes in the behaviour of individual companies who are perhaps more mindful now of the value of individual workers, the skills that those workers can acquire over the course of a long period with an individual company, which makes firms reluctant to part with labour even when demand is weak. I wouldn't necessarily say that that's a significant reduction in overall flexibility. That's probably a good thing for the long-term health of the economy.
Do you think it would be a problem for the approach of the Monetary Policy Committee if the labour market here became less flexible?
Well, to the extent that it would increase the natural rate of unemployment and therefore worsen the trade-off between the level of unemployment and the performance of the labour market and the prevailing rate of inflation, yes.
That answer's predicated on a British labour market. But of course, as we've seen repeatedly with new jobs being created, large numbers of those new jobs have been filled flexibly by the European labour markets. I mean, can you conceive of economic problems should we move out of the single European market in terms of labour mobility?
I think what I would say is that on balance, I would argue that that freedom of movement across borders over the course of the past few years has been beneficial to the UK economy in terms of allowing new skills and in terms of filling jobs where there has been demand. So I think, yes, were we to move out of that degree of flexibility cross-border, then I would be concerned.
I mean, if we were to pull out of the single market, I mean, the more than whispers we hear from American and Japanese business people is that they would look at investments here. That's one issue, but this issue of labour market flexibility is another. Can you conceive of a possibility? And there's the political issue of whether we're in the European Union. but the European single area is a separate factor, i.e. direct access to the single market. Can you conceive of a situation where we could leave both the European Union and the European single area and therefore be outside the single market?
I'm not quite sure what you mean by can I conceive of this. Clearly that is a political decision on the part of both the electorate and the elected government. I'm not going to comment on that as a hypothetical future solution. I think that to the extent that we have that flexibility in both our employment market and in the extent of investment flows, these are both of benefit to the UK economy.
And finally, I mean, how would you summarise the impact were we to be outside the single market? In other words, outside both the EU but also outside the European single area. What is the economic impact of that happening within what would be the end of the current economic cycle, 2017?
Well, I'm not going to speculate on any timing of any change in our relationship. As I've said, I think that the benefits both to the labour market and to the flows of FDI are beneficial.
Professor Miles, could the committee just have your view on flexible inflation targeting? That flexibility reflected in the time frame over which inflation has been brought back to target has always been interpreted under cross-examination before this committee as 2 years, partly on the grounds, no doubt, that that's the sort of time it takes conventional monetary policy to feed through, or to most of it to feed through. Do you think that it is still 2 years as defined now, as interpreted, I should say now, flexible inflation targeting, or should we think of this as a longer time frame?
I'm not sure the two-year horizon has ever been quite so clear. I mean, it certainly isn't part of the remit.
I don't have the quotes in front of me, but I can assure you Mervyn King has given statements to this committee to that effect.
Well, I mean, the remit, which I don't think has changed materially, maybe not changed at all in the relevant parts of it, the remit has always said that if inflation moves away from the target level, shocks have taken it either above or below, then it doesn't make sense. It wouldn't make sense for the Monetary Policy Committee to try and come back to target in the shortest possible period, because that could involve enormous swings in monetary policy, which would generate enormous swings in the real economy. So there was never in the remit any statement about and 2 years is the appropriate horizon. I think I'm right in saying that until about 2004, it was the case that the fan charts in the inflation report tended to go 2 years ahead, and I think from 2004 that was extended out so that we showed 3 years. But even that wasn't a sign that somehow the right horizon moved from two to three. I think it's a matter of judgment what the trade-off is between trying to move inflation back in a very short period as opposed to over a slightly longer period.
And what's your judgment on that question?
It depends very much on what the reason why inflation may have moved away from it is.
Okay, what's your judgment on that question?
I think where we are at the moment is a situation where on the central forecast, which is that inflation is near the target level but somewhat above it 2 years ahead, but pretty much at it by the end of 2015, to my mind that is consistent with the spirit of the remit. Now, if you focus just on the 2 year ahead horizon, so the first quarter of 2015, the single most likely outcome is that inflation from memory is 2.3, 2.4, something like that. Although there is a chart, I think it's, actually I've only got, it's on page 41 of the inflation report, it's chart 5.5, which shows the probability that inflation is above or below the 2% level at different horizons. And just looking at it here, if you take the 2 year point, I mean, roughly speaking, it says that Our judgment is that there's around about 55% chance we're above 2 and a 45% chance that we're beneath 2. So it's not 50-50. That doesn't happen until a little bit further down the road. My own interpretation of that chart is that that profile is consistent with the spirit of the remit we've been given.
Can I come in a second? I just want to clarify what Professor Miles is saying. You're implicitly saying there hasn't been any change in the interpretation of the horizon over which inflation will be brought back to trend since, as far as you're aware, since 2004.
That's correct. I mean, I certainly, maybe I should just speak for myself. I mean, having sort of looked carefully at the remit, I haven't changed my interpretation of what that made acceptable and unacceptable.
And therefore, when we hear all this talk about inflation, flexible inflation targeting, there's been no background briefing going on to the press, and it has all just been a bit of a press storm in a teacup.
I have always thought that the remit defined flexible inflation targeting, and that remit hasn't changed.
You're answering yes to that question of mine. You're answering
that
yes.
There hasn't been a change.
That the press talk about all this was a storm in a teacup.
I think so, yes.
Okay. Now, everyone seems to want to chip in. Quick remark from Mr. Bean and then Mr. Tucker.
Right. Let's get this absolutely clear. The notion of flexible inflation targeting has been around a long time, right since pretty much the birth of the inflation target regime. The governor in his speeches often talked about it in terms of constrained discretion, but it's essentially the same thing. The idea is present in the academic literature from the 90s, describing how to operate an inflation targeting regime. The 2-year thing I think it really came about almost by accident, because in the early days of the regime, we wanted to emphasise that there was very little we could do to affect inflation today. You could only affect inflation further down the road, because it takes time for monetary policy to affect demand, and then for the change in demand to feed through into inflation. Now, if you just have one-off cost shocks, they've typically passed through the system by a couple of years. Circumstances at the moment are slightly different, because some of the cost shocks that we're being subject to, in particular in this area of administered and regulated prices, will take longer to pass through, because they're not just applying to this year. We know they're going to recur next year and possibly a little bit beyond there. So it makes sense to be thinking about bringing inflation back rather longer. But I mean, certainly I have never subscribed to the view that there was something magic about 2 years. And the whole reason that we introduced the extra year onto the forecast back in 2004 was precisely to try and get people away from focusing rigidly on where our central projection was 2 years out. The other thing I would say, in a number of speeches before the financial crisis, I talked about whether monetary policy should lean against the wind of a building credit asset price bubble, and made precisely the argument that it may make sense to quite consciously undershoot an inflation target if it improved your chances of hitting it further down the road.
That's another big question. But
It's a very big question.
Just to be clear on the first point, you're saying there was always 2 to 3 years since 2004 built into this.
Yeah.
Yes.
And that hasn't changed a scrap.
Yes, and actually
therefore
before
you're agreeing with Professor Miles that all this press talk is a storm in a teacup.
Yes.
Okay.
The one rider I would add to that, you can have a legitimate question, and this is a policy judgment, about how much flexibility you want and what sorts of shocks you might be willing to accommodate, and that's a real issue.
Okay. Well, we may well come on to that in just a moment, but Mr. Tucker was particularly eager to get in.
Very quickly. First of all, the 2004 change, which I was part of, was significant. We wanted to disabuse the world of focusing overly on 2 years. My recollection is that sometimes inflation was projected to be around target at 2 years, but the slope was upwards or downwards. Well, actually, of course, that means that the horizon wasn't 2 years, because we were effectively projecting that it was going to depart from target off screen, as it were. The 2004 change was very significant. I was particularly keen on it, to get away from any obsessive thing like that. The other thing I would say to you is this point about being flexible in inflation targets has to be repeated over and over again, and the language changes from one generation to the next. The way Eddie George put it was in terms of not being inflation nutters. The way Ben Bernanke and Mervyn talked about it was in terms of constrained discretion. Today, the popular language has become flexible inflation targeting. Don't get seduced that there's anything significant going on. The third point I would make, very quickly, is far more significant than what we're projecting now and taking roughly 3 years, is we allowed inflation to go to 5%. We could have squeezed that out of the economy by pushing the economy into a deeper recession. I said to you before, this was the biggest judgment I think we've made since the committee started, and it should assure everybody that we are, in today's language, flexible inflation targeters, but without ever taking our eye off medium-term inflation expectations. None of this, I trust, is resulting from a commitment to sound money, and that's the thing of which you need to be repeatedly assured.
John Thurso.
Can I come to you, Dean? And particularly I want to ask a couple of questions on your annual report. But I'll start, because we've just brought it up, with the point that you made that inflation has been subject to further adverse shocks, including much larger than expected contributions from university tuition fees and from other, quote, administered and regulated, unquote, prices. Were you surprised by those changes to these prices?
Which ones particularly, or I mean
either
all of them? Okay, as far as the university fees go, the effect turned out to be bigger than we expected. Now, we obviously knew that the tuition fee increases were coming in, but what we didn't know was precisely what the mix of the student population was going to be between different fee categories. And
so how far apart was the reality from what you were estimating?
I can't remember when it first came into the, it would be around November, I guess, wasn't it? So corresponding to the September RPI, it must be. But that was significantly higher than we had expected. And as I say, I mean, it wasn't down to not knowing what levels of tuition fees were, but we didn't know what the student mix was going to be until actually the students turn up.
And with regard to the administered and regulated...
Okay, now, I mean, there's a number of ones there, like things like sewage services and so forth. But I think the one that has, if you like, been news to us recently has been energy and utility prices, where obviously we've had big increases in those in the past, but that's generally been driven by the wholesale price of energy, oil and gas on the world market. But this time there's also other increases associated with things like the cost of transmission networks, distribution networks, which are contributing significantly. And from what we've been told, they are going to continue to contribute over the next year or two. As I say, so that is news to us relative to where we were 6 months ago.
I mean, these are all things that, from the outside, one might say had a degree of predictability, in the sense that we knew tuition fees would have an impact, but as you've explained, it was the degree of it that was the surprise. But we know that the work that's been done on transmission charging and the upgrading of the system and so on. So the question that is behind that is, to what extent do these things come as a shock, and to what extent should we actually be looking to say, well, there's always going to be things like this. Does this not call into question the fundamental forecasting?
Well, I mean, firstly, you don't know how the energy companies are necessarily going to respond to that increase in costs. Even if you know something's going up, they may well absorb it in terms of lower margins. Now, we talk to the energy companies, and so we get intelligence from them. As soon as we learn something from them, and we can incorporate in our forecasts. And obviously, the staff try and keep ahead of the game on these things as much as they can. But one has to admit that, you know, there are times that, you know, we find out something and you think, oh, you know, maybe we could have discovered
the reason I raise
sooner.
it is if you take your paragraph about the picture generally, as it starts off, there is this one sentence that really picks out these things as further adverse shocks, including much larger. So you've picked it out.
Well, that's because it's relevant at the current juncture, but it's not as big a disturbance, obviously, as those huge movements in oil prices that we see. That the price of oil during the last 5 years has been between $35 a barrel and $145 a barrel. Sterling has fallen 25%. That's a huge shock. Now, the administered and regulated price bit is not the same order of magnitude. Normally, these components of the basket, which are about 16% of the basket, would contribute something like 0.5 percentage point, maybe a little bit less, to inflation. Over the next year or two, we expect they're going to be contributing about 1 percentage point, so that's half our target. So it's a reason why you would expect inflation to be running a bit above our target. It wouldn't be a justification for inflation being 5%.
I mean, we've had, sort of, I think every year since I've been on this committee, something of that nature. Well, and I just wonder when, if I can ask the Michael Fallon question, at what point do we arrive at the point where we're saying, well, actually, there are these changes every year, and therefore, actually, we ought to say it's not the medium term, it's a long-term problem? Well,
I think the unfortunate thing about the last 5 years is that the shocks have been predominantly in the upward direction. Now, it's perfectly reasonable to think there are times they'll go in the other direction, and some of the shocks within this period, say the original cut in VAT, the start of the financial crisis, and when oil prices collapsed in 2009, that's obviously something that goes in the other direction. But overall, the last 5 or 6 years have tended to be characterized by a sequence of different upward shocks. I think the way you get into difficult territory is if you have a shock which you know is going to keep on recurring year after year. So arguably we did have a shock of that variety in the pre-crisis period, which is still having some effect, and that's the downward pressure from access to cheaper manufacturers from the emerging markets, especially China. The question then comes, in the sort of environment, the sort of regime we have, if you've got that repeated shock, should you be saying, I'm going to keep on looking through it, or should you say, well, actually, in these circumstances, I should be aiming to hold inflation at 2% and ensure the other wages and prices adjust in the economy appropriately.
Okay. Can I turn to the second question I wanted to ask you, which comes from your last paragraph explaining monetary policy. In May last year, you made one of your speeches which was entitled, I think, Pension Funds and Quantitative Easing. And you were really seeking to address the question of whether QE is having a negative impact on pension funds, and broadly you came to the view that they weren't. So we've recently had considerable evidence from people representing pensioners complaining fairly bitterly about the impact. Do you think they're wrong to be complaining to us about that?
Well, first of all, I should clarify what the conclusion of that speech was. I mean, one of the things I wanted to do in that speech was draw attention to the fact that QE affects both sides of pension funds' balance sheets.
Yes, and you made the point that where you start from has a big impact on where you end up.
And absolutely. There's no dispute that if you're a pension fund that's in significant deficit, that the downward pressure on yields that has been associated with quantitative easing will have worsened that deficit. And basically those pension funds are short of the assets that they need. They have to pay more to purchase those
because
assets.
it has
I want to stress, I wasn't disputing that fact, and the sort of numbers that I came up with are in the same ballpark as the National Association of Pension Funds. But I think it is very important to try and unpick movements in deficits which might be associated with quantitative easing from the movements in deficits, say, that might have resulted from the big collapse in stock prices that happened around the start
If
of
one
the
looks
financial
at
crisis.
pensioners rather than pension funds, of course the complaint is that the particular problems arise when you are converting to an annuity at this time, because you will get a particularly bad rate. We now have far more pensioners than we've ever had before, and they were, until 5 or 6 years ago, a major boost to the economy. They were, I mean, people in marketing were writing books about the Grey Panthers and the amount of money they had to spend. That's a consumptive force, consuming force, that is being quite severely constrained. So in the light of that, should we not have some concerns about the suppression of that purchasing power?
Well, I mean, first of all, the bulk of pensioners were already retired. They'll be drawing their pension already, and in some cases, they will be holding assets, bonds, equities, which will actually have gone up in value. So they could actually be made better off. The group who you might have more concern about are the people who started drawing their pensions during the last couple of years. You're exactly right, their annuity rates are lower. Whether they're actually made worse off or not depends on how they had invested the assets which they're converting into an annuity in the first place. If they've been invested in a mix of bonds and equities, roughly speaking, the two effects offset. That's broadly speaking, what our estimates suggest. Now, most pensioners drawing the annuity probably don't really associate the movement in the value of their pension pot as being associated with our monetary actions, but they too associate the declining annuity rate. So they sort of see one side of the picture and not the other.
Final point, which is slightly off-piste, but it's along the same lines, which is the concept of finance fiscal deficits, and obviously relating to Adair's speech last week, which I read with great interest. To what extent ought we, instead of trying to string up a pipe with QE, actually start pouring money down the pipe with helicopter money?
Okay, I think there's some woolly thinking in this territory. I'm not suggesting that there was
quite
woolly,
happy
but,
to admit
okay.
to woolly thinking.
No, but
I've done it all my life.
I mean, helicopter money. It was an intellectual experiment that Milton Friedman introduced to make a theoretical point. In practice, if you wanted to do helicopter money in the real world, what it will involve would be a tax cut, an increase in tax allowances would be the natural way of doing it.
So this would be the personal tax allowances?
Yes. Okay, basically you've got to get the money to people.
We've started, have we? With
Okay, well, but I mean, that's the way you get it there, and then you can envisage this as being, okay, the first leg of that is financed by selling some government bonds, and then we go and buy the government bonds on the secondary market in exchange for the money that we create. So we're exchanging bond liabilities for monetary liabilities of the state, essentially. And any action of this sort, you can always split into what is essentially a fiscal action and a financing action. We do the financing bit with QE, and if you like, you can think of a large chunk of the deficits in recent years. There's been some temporary monetary finance that's gone along with it, but which we will unwind in due course. So, but the real issue for you is, do you want to do the first leg? And if so, is an increase in tax allowances the most sensible thing to do? One of the things that we know, if you have a temporary increase in people's income, they tend to save most of it. So it's probably not a very effective way of getting the economy going. But the question of whether there should be more fiscal action, that's up for you and the Chancellor to decide.
So
we do the financing
just
end.
one very last. Helicoptering money would be a Treasury call, not a bank.
Yes, absolutely, absolutely. The first leg of it is the Treasuries.
The King helicopter then is still under the...
It needs an Osborne engine.
Yes, it needs an Osborne engine. Mark Garnier.
Thank you. Mr. Bean, if I can carry on with interest rates, and just start very quickly with this Moody's downgrading that we saw on Friday. Just prior to the downgrading, the 10-year bond yield was 211 basis points. Obviously, it's now been downgraded, and the markets have suggested it, and we're now actually 201 basis points. So, in fact, the bond yield has gone down, arguably on the back of this. And what are your thoughts about what's going on?
Well, I mean, I think the downgrade is largely a reflection of the economic developments in the economy. I don't regard it as having a great deal of news in and of itself. It's obviously significant in the political sphere, but in the economic sphere, the impact of disappointing growth, a slightly worse fiscal position than the government expected and so forth, that was already being gradually discounted into the to government bond yields. The markets largely have been expecting a downgrade, and possibly other ratings agencies may follow suit. This is, of course, just one notch. There's a lot more notches to go. But the actual downgrade itself, from an economic perspective, I don't see as adding anything new.
In itself. I mean, I'm just sort of slightly more interested in the fact that we've seen a 10 basis points fall in the gilt yield in a day and a half.
Basically gilt yields and the exchange rate have bounced around in the last couple of days. So after the Moody's announcement, yields went up and the exchange rate fell. Just today, on the back of the Italian elections, it's all been reversed. So.
No, fair enough. Just getting back to the low interest rates and the effect of QE, we had Dr. Ros Altman recently who came before us, and she was arguing that these, the effect of QE is to reduce the risk-free rate to next to nothing, thereby inducing people to make sort of fairly peculiar decisions as to what is a good return, and possibly go into quite risky assets in order to try and seek yield. Do you think she's got a point?
Well, she's got a point in the sense that that's how QE works. The whole idea.
But it's artificially adjusted risk.
Well, when you say artificially, what we're doing is we're changing the composition of the state's liabilities in a way that drives down long-term interest rates, and it encourages investors of all sorts to move into riskier assets. What we have at the moment is, if you like, excessive risk aversion. So we're by undertaking QE, we're leaning against that. Now, it's quite reasonable to have concerns. You don't want to push it too far and end up generating something which creates problems when it unwinds. So that's obviously something we look at very closely. Also, you'd get very worried if it was generating a build-up of leverage as people were trying to exploit yields elsewhere. We haven't seen that. What we've seen so far, we think, is largely a plain vanilla switch into riskier assets. These are things like corporate bonds. They don't have to be really risky assets, but corporate bonds, equities. So it reduces the cost of finance to businesses, and that's how you're trying to stimulate demand in the economy.
Okay. It's fair enough. So you're So you're encouraging people to try and look for riskier assets.
Yes.
Okay.
Yeah,
Right,
that's how it works.
She also argued that because you've got this sort of artificial effect, and Paul Tucker pointed in your views on this, because you've got this artificial depression of yields at the moment, that when it goes back to a period of normalcy, if you like, it's more likely to snap back rather than go back in a sort of controlled sort of way. And given the fact that we've got £1.46 trillion, I think it is, worth of household debt, clearly that's going to have a very, very severe impact on households. Again, what are your thoughts about how things are going to go back to a period of normalcy, if you like? And do you think there's a significant risk for households?
Okay, I mean on the final point about it having a large impact on household debt, that's not so obvious because most households are not borrowing 20 years. I mean, their interest rates are determined by the much shorter end. But the generic point here about what happens as we move towards withdrawing the stimulus is an important one. I think really all central banks have been making these large-scale asset purchases are aware of the risk of getting a sharp snapback in the yield curve. The example that is regularly given is what happened in the United States in 1994. What that means is that we will need to have to try and manage that process carefully to avoid the markets overreacting. It's likely that we will unwind our purchases over a relatively long time period. We're not going to try and sell all the gilts back within the space of 3 months or anything like that. It will be over probably an extended time period.
But nonetheless, if the market perceives you as being in the process of unwinding QE, then it will try and predict it, and that's where the risk
indeed, and that's why our communication and our messaging will be very important leading into that, and that we will need to signal clearly to the markets when we're moving in that direction, give clear signals about the sort of pace at which we expect to do this. But you're absolutely right that there is an issue here that we will have to deal with.
And of course, not only will you be competing with the markets that are going to be trying to predict what you're doing, you're going to be competing with the government, who also has to go into the gilt markets. I mean, Paul Tucker, do you want to add anything?
It will be. You're absolutely right. The lessons from 1994, which it should be remembered, not only caused a dislocation in bond markets, but almost caused some of the largest financial institutions in the world to fail, not on this side of the Atlantic, is a salutary tale. The lessons are, as Charlie said, to communicate clearly so that people don't overreact. But we can also make errors the other way as well. I mean, looking back to a decade ago, if one signals that one's going to move in super slow motion when the economy warrants something else, one can store up trouble as well. The other thing we'll have to do, and the substantive thing I would add to what Charlie said, is the supervisors are going to have to be aware of what interest rate risk positions the banks and the other key players have. That was the thing that that should have been understood in 1994, and it wasn't.
And then David Ruffley.
Yes, I just wondered, Mr. Tucker, what you would say to Dr. Ros Altman's accusation that, or her assertion that in surveys of the over 50s that QE's impact on them has been to persuade them to save rather than spend. And is there a risk, or have you ruled out the risk that QE has in fact stifled consumption in some way?
I think that without QE in 2009, the economy would have sunk away in a desperate way, and that would have been hugely damaging to savers. And I think QE has helped over the past couple of years as well. It's underpinned, it's brought down the cost of capital, and it's underpinned wealth, and net that has been a positive thing.
But we need consumption, don't we?
We do need consumption, but the most obvious reason that consumption, we need consumption, but we also need net trade as well, even more. The most obvious reason for arrested recovery is where you began, which is a huge threat during last year from the euro area that diluted the traction that monetary policy could have. We were affecting the financial markets in a powerful way. That wasn't being transmitted into spending. Why not all monetary policy? Every instrument we have is trying to get somebody else to spend, households or businesses. If they, to use slightly extravagant language, think that the world might be about to come to an end, they squirrel some money away or defer investment. I think, as I said in my annual essay to you, that with the euro area risks having receded somewhat, that actually the QE we've done can gain traction and help a recovery in spending. I wrote that, of course, before the Italian election results, and we'll have to see just how potent effect they have on markets and on sentiment.
Just on a very closely related point, what are the risks of a currency war, Mr. Tucker?
Well, we must avoid them. We must avoid them. We must avoid slipping back into protectionism. We must avoid balkanization in global finance. We must avoid bigger-than-neighbor policies generally. And as Mervyn has said overnight in Tokyo, we can avoid all of these things as long as central banks around the world and other policymakers stick to their domestic price stability objectives. The most important choice about monetary policy in this country over the past 20 years has been to have a domestic price stability objective rather than an external anchor. That's what we did when we came out of the ERM. That's what we have been given to do, and we must do that and nothing else. When you ease monetary policy, when you're expected to ease monetary policy, that will have an effect. Can I say one other thing, though, that I think is tremendously important about this, and I fear has had some effect, modest, over the past few weeks, but we must be very careful about. If either we or other central banks signal that we are going to tolerate a higher level of inflation permanently, if we were to somehow lead the markets to think that we liked 3% and that's what it was going to be, then yes, you will find a fall in the exchange rate, but it will be a fall in the nominal exchange rate only. It won't be a fall in the real exchange rate, and it will do absolutely nothing for the recovery in net trade. That our ability to conduct monetary policy in a way that is helpful to the economy and helpful to the recovery depends absolutely on our commitment and belief in our commitment to sound money, which means the 2% inflation target over the medium run. And we need to be immensely careful when we talk around the world about these things, that isn't put into question.
So just to be clear, there's no tacit policy or acceptance of a real sterling devaluation?
No. What there is on the one hand, we say, as a matter of analysis, that we believe that the real exchange rate needs to fall compared with where it was a few years ago to get the necessary rebalancing in the economy. As a matter of policy, when we set our instruments, we are trying to achieve 2% inflation target over the medium run without exacerbating the recovery in the near term.
David Ruffley.
I'd like to begin by asking two clarificatory questions. The first relates to QE, and for Mr. Tucker. To your knowledge, has there been any member of the committee who's advocated cancelling the gilts that you bought under the asset purchase facility? Because as I understand it, the reason that wouldn't work is that were you to cancel those gilts that you hold rather than unwind the position by selling them back, one, you would reduce a tool for tightening monetary policy, but secondly, you would still have an ongoing liability to pay interest on the reserves that have been created, and that would logically mean you either hold interest, the policy rate at zero, not very likely, or that you had to create more electronic money to satisfy the interest that you owed the banks in question. Now, I understand that. But has anyone on the committee ever articulated that as a way of easing policy into the future?
Not that I recall. I stand subject to correction by others. Not that I recall. I think it would be a stunt, and for the reasons that you say, if you did it on a grand enough scale, we'd go bust.
Yes. No, it's why it was a clarificatory question.
Which on the whole would be a very bad thing.
Yeah.
I mean, I have certainly put exactly the argument that you've just made in one of my speeches.
On the 31st of October. Yeah. I remember. The second question is for you, Professor Bean. It's the point you raised about helicopter money. am I right in thinking that, to your knowledge, neither you nor any other member of the MPC has discussed the fiscal proposition which would be part of a helicopter drop? That is to say, have you spoken to ministers, or are you aware of anyone speaking to ministers about that fiscal part of the equation?
I mean, I certainly haven't. I mean,
You haven't?
I can only obviously talk from my own personal discussions. I mean, others here, you know, they may meet people, they may have had discussions. I somehow doubt it. But
Perhaps just very quickly, because we've got just under half of the MPC here. Have any of you, other than Professor Bean, discussed helicopter drops in the terms that Professor Bean described it, that there would have to be a fiscal judgment to cap taxes, which is clearly nothing to do with the bank, but have you aired that, Professor Miles, with current ministers?
No, and I completely agree with the analysis of Charlie Bean on what helicopter drops mean. And I did talk about it at some length, actually, in a speech I gave last year at the Scottish Economic Society lecture in the middle of the year, and pretty much said what Charlie just said. So I quite agree with his analysis on this.
Yes. Any discussions with ministers about...
I think this, if I may say so, I think this has been... I mean, on the one hand, it is important that analysis of all kind is out there. On the other hand, I think we need to make it clear that we are committed to sound money. And the reason I say this is as follows, and this is consistent with what Charlie said. One version of helicopter money is the core idea is the government pursues a fiscal expansion and we finance it with the printing of money. So the important question is who decides what? If the government decides on a fiscal expansion, any government, and orders us to print the money, then that's abandoning the current monetary regime, and do not expect the markets to react pleasantly. That will be taken as an abandonment of sound money. The alternative political economy outcome is a government wants to undertake a fiscal expansion and have it financed with the printing of money, and we say, oh, we're not going to print that money, or we'll only print it up to such and such. And everybody feels that that's the Bank of England telling the government what its fiscal strategy is. The final thing I would say, and I think this is tremendously important, is that before things have to get much, much, much worse before any of these ideas were even remotely serious. And before that, debt-financed fiscal expansion would be contemplated by almost any government rather than printing money to have a fiscal expansion. I'm not advocating that should be the case now. I want to make that absolutely clear. But in the interests of filling out the analytical space, there is a risk that the markets and you as Parliament and the public are misled as to where the policy debate is and should be at the moment.
That's very helpful. And for the avoidance of doubt, neither of those two positions on cancelling gilts or helicopter drops are positions I advocate. It's why I said they were clarificatory, and I think that's very useful, your responses. Could I turn to credit flows to the economy and funding for lending? Perhaps I could stay with you, Mr. Tucker. Do you think all credit is equal, or do you think business lending has a greater stimulatory effect than mortgage lending?
I don't know. I think both matter enormously. Households and consumption is the biggest part of spending in the economy. Small and medium-sized businesses are the lifeblood of the productive side of the economy. I am worried, as are others, that our current battery of credit policies may not be reaching as far into the SME sector as they might. And I should make clear that in saying this, I'm speaking for myself. I think we need to be watchful of two things. The first is not all lending to small firms and medium-sized firms in the economy comes from banks. It also comes from non-banks. At present, the FLS is for on lending to households or on lending to firms. I think we should have a think. I'm neutral about what the outcome should be, to be clear with you. I think we should have a think about can we harness non-bank lenders in some way, possibly via the banks. The other thing, second thing, and I talked about this in a speech in late spring of last year, is I find it regrettable that the markets for working capital finance in this country aren't as healthy as they were a generation or so ago. Now, in old-fashioned speak, this was the bill of exchange, and I do not want to be represented or represent myself as saying, let's go back to the bill on London, 1870 was absolutely tremendous. But I do think, and I called last spring for bankers and corporate treasurers to work on this. I actually think that the authorities and the bank could play a role in that. And because the lifeblood of working capital finance, to medium-sized firms at least, for around a century, was a trade finance instrument that was transferable and that was marketable and that we would buy. And there is so much debate about the Bank of England not being prepared to lend to companies. And that isn't true. We are lending to companies via the FLS. I would simply like to explore whether or not some kind of working capital finance instrument could be rejuvenated. I do not have a plan in my pocket for how this should be done. My years of being the markets director are behind me. But I would like that to be debated.
It's a very interesting answer, because what took my eye in the February minutes was exactly this point, that consideration of measures to support the flow of credit more broadly, including from non-bank lenders, was also warranted, and
so that's a reflection of something I said.
But I just wanted to clarify.
Absolutely.
Was it?
I'm not just saying this to you.
But these are in the minutes rather than it being a personal and brilliantly articulated view. But what more work is the Monetary Policy Committee going to do in relation to that, perhaps? Professor B.
Well, I mean,
because it seemed to be a policy committee view that this should be explored, consideration of measures.
No, it was part of the discussion. We had quite a wide-ranging discussion of various options, in the course of which Paul said pretty much what he's just said to you now. And the question then is, can we come up with a scheme that looks like it might be attractive, might work? These may not be things that we alone can do, but this is something we need to do, put some thought into.
Yeah. Right, but
that's basically Paul's
I think this is helpful. I mean, when will you be in a position to let this committee know, or is research being done on this? Or?
Well, it will be something that we will work on inside the bank to see if we can come up with schemes. It's obviously an area where the markets side have a particular role.
Yes. So in the fullness of time.
In the fullness of time, I think is the way to. We may decide there isn't anything useful we can do in this sphere, but Paul is perfectly reasonably saying we should think about it.
It's very useful, and with your permission, Chairman, just one final and brief question. The funding for lending initiative is currently controlled, as I understand it, between your executive and the Treasury. Now, given that the role of the FLS is to plug a gap in the transmission mechanism of the Monetary Policy Committee, is there scope for it to become more closely controlled by the MPC as an MPC tool, and what's the dynamic with HMT?
Okay, I think first of all, I mean, we operate the FLS. Okay, we do the mechanics of it, so forth. The bank staff monitor the collateral and all of that. The other thing is, it's not a scheme which lends itself to continuous tweaking in the same way that you might with bank rate or the quantity of asset purchases. What the FLS does is basically supply banks with funding cheaper than they can get in the market. The reason we introduced it was precisely because funding costs have been rising through last year, partly on the back of what was going on in the Eurozone, and we were worried that that would lead to a credit crunch, and there were signs that might be starting to happen. So the primary aim was to work against that. And indeed, funding costs have come down very substantially in more than 100 basis points. So it's achieved what it set out to in that regard. But we also put in these extra incentives to encourage banks to lend more than they otherwise would have done to the real economy, the way the scheme is priced. Now, as far as the banks are concerned, they want some certainty about the pricing of the scheme, in deciding whether they're going to take advantage of it, how to extend their lending and so forth. And it wouldn't be constructive of us to be continually tweaking the parameters from month to month. If it was the case that it was clear that we'd got the calibration of the scheme wrong and it wasn't having the effect that we thought it was going to, then we'd obviously need to think, do we need to change something? But frankly, the way it's working at the moment is pretty much as we expected it to. We've seen the effect on funding costs that we wanted to see. That has largely passed through into the rates that are being charged, certainly on household mortgages, and the availability of finance to larger companies. There's less evidence so far of the effect that we'd like to see for smaller companies. But certainly they're the group that have less access to alternative sources of finance. So
already,
yes.
many of them cash rich.
That wouldn't necessarily be true of all businesses, but certainly many of them. But we did expect it to take more time to feed through to the smaller company end of things, where it's more heterogeneous and so forth.
We'll keep an eye.
But we're keeping an eye on it.
Now, Mr. McCafferty and Professor Miles, you've been virtually spectators for the last 20 minutes or so. I just want to give you an opportunity to add the thing. First Mr. McCafferty and then Professor Miles to what you've just heard. You don't have to if you've got anything you want to say.
The only thing I would add at this stage was in answer to Mr. Ruffley's question, which is I haven't spoken to ministers about fiscal issues. I agree with everything that my three colleagues have said about the analytics of the issue, and I do think one of the most important elements of the current QE programme, which would lose with either helicopter money or with the cancellation of gilts, is that ability to reverse the policy. I think that is actually critical to our credibility.
Okay. Professor Miles?
Just something coming back to the issue about the impact of QE. And I agree with something that Ros Altman has said and said to this committee, I think, which is that one of the side effects of QE is that it generates a search for yield. And as Charlie said, actually that's a good thing, that's not a bad thing. And I think one side effect of search for yield has been the knock-on impact in the corporate bond market, where yields have come down over the period when we've been buying gilts very, very substantially. And the number of companies and the number of new companies that hadn't issued in the corporate bond market before has increased. And I think part of the helpful side effect of QE is to increase somewhat the universe of companies that now think about using the corporate bond market. Now that doesn't stretch all the way down to small companies, but it begins to stretch down to some of the medium-sized companies, and that is exactly one of the beneficial side effects of QE.
Helpful illustration of guidance on yield compression, and it's not all necessarily bad. You have to be very quick, Mr. Tucker. You've had a good innings
I
so far.
absolutely agree with what Charlie and David have said about search for yield as put, but I would hate it if in 5 to 10 years' time we have quoted back to us, well, the Bank of England was encouraging a search for yield blind to the risks that could build up in the financial system.
Well,
the whole point of giving us both functions, and I've said this publicly and I'm sure you have, we need to have two sides to our brain. While monetary policy might desirably stimulate risk-taking, we have to make sure that that risk is taken in places that can bear the risk if and when it crystallises, rather than blowing up the world
we'll
again.
settle for two sides, one brain rather than two brains. George Moody.
Mr. Tucker.
Paragraph 36 of the minutes of the Monetary Policy Committee opens, the committee discussed the appropriate policy response to the combination of the weakness in the economy and the prospect of a further prolonged period of above target inflation. It deals with the latter, inflation, for the rest of the paragraph, and then finishes with an intriguing The committee also agreed that it stood ready to provide additional monetary stimulus if warranted by the outlook for growth and inflation. Now, as you've dealt with inflation, I'm just surprised and saddened by there seems to be no appropriate policy response for the outlook for growth. And the business of warranted by the outlook for growth. If you've spotted growth in the last 2 years, Mr. Tucker, I'd be glad for you to point it out. And so, why did you and the other members of the committee, excluding Mr. Miles or Professor Miles, think there was no necessity, it didn't warrant any policy response for growth?
I'd say three things.
Could you speak up slightly?
No, absolutely. I'd say three things. First of all, we wanted to make clear in the last sentence that nobody on this committee thinks that QE has reached the end of the road and that it's not a useful instrument anymore, and we stand prepared to do more if we judge that necessary. And given speculation about whether we do think that QE has reached the end of the road, it was important to make that clear. Secondly, in my own case, as I made clear in my annual essay to you as well, I think that the QE that we have already done is likely to gain more traction now that the headwinds from Europe have receded somewhat, subject to Italy overnight, on which one can't yet form a judgment. But I think that's a really important point, Mr. Moody, at least for me, which is we did this QE last year. It affected financial market conditions. The effect on spending was effectively switched off for the reasons that I've described earlier, because of the huge uncertainty and threats coming from the international environment. As those recede, I would expect the effects of the existing QE on financial market conditions to start to affect the economy. That weighed with me. The third thing I would say is I think we're absolutely conscious of trying to support growth consistent and recovery, consistent with maintaining inflation conditions. We're not inflation nutters. I promise you that if it became perceived that we had given up on inflation and that we were only going to support recovery in growth, what we would find after a few quarters was that we couldn't provide that support for growth because the bond markets and everybody else had reacted adversely. It's only by maintaining our commitment to sound money that we can do what you personally most want us to do. Now, will we get that absolutely right every month or every quarter? Of course we won't, but I really don't think you should take away from this any lack of willingness to support growth. I mean, by letting inflation go to 5% on a judgment that perceptions of our commitment to price stability weren't diluted, we were doing that precisely so as to support
but that's not a choice
growth.
that's necessarily on the table, is it, letting inflation go to 5%?
No.
But it's interesting, Mr. Tucker, that you responded only on QE, as though that was the only...
No, it's not.
No, I'm going to ask you.
Absolutely.
It was an appropriate policy resort. It wasn't specifically about QE.
Yes.
And two of your 3 points was on QE, and the other one was on inflation, which in the paragraph you've dealt with without any warning of a 5% inflation rate. But let's come to paragraph 33.
Can I just say on that,
Mr.
Moody?
Well, I'm going to... Yes, go on then.
Well, I answered the question in terms of QE, but as I said to Mr. Ruffley earlier, I personally have been raising questions and promoting ideas about how to...
No, Mr. Tucker, that's the next question.
That's where you're going. All right.
You see, we go to paragraph 33.
Yes.
The committee reviewed the range of possible monetary policy instruments.
Yes.
You list them, or you list some of them, and then you say the ones you list all had drawbacks, and so these drawbacks remained, and that excused you for accepting any of these. The committee would nevertheless continue to examine all of the policies potentially available to it. it, such as...
Such as...
And you see...
Yes.
Well, I'd ask two questions on that. What are the drawbacks that you've experienced with purchase of alternative assets? And then secondly, what are the others available?
So I will come to the purchase of other assets. I've talked about FLS already. We touch on in this paragraph reducing bank rate or the rate paid on reserves from 50 basis points, say, to 0. One possible risk of doing so is to make life even harder for some of the building societies and small lenders.
No, I haven't raised that one.
Specifically,
Mr. Tucker,
Yes, all right.
time is, sorry,
well,
but time is very limited, and I'm asking specific questions. The question is, on the alternative asset purchases, what are the drawbacks? Secondly, what are the others that are possible that don't have drawbacks, but that you've omitted to put on the table for consideration?
On the second, I have raised the question of what the limits would be to setting
negative... No, I'm not asking what you... No, sorry, again. No, Mr. Tucker,
well,
again, specifically I'm asking about your minutes. There were others. Can you tell us what others were on the table, didn't have drawbacks, but you've decided in the fullness of time, to take Mr. Bean's phrase, in the fullness of time you'll come round to...
We're going to continue thinking about these. Yeah. I hope we will think about whether there are constraints to setting negative interest rates. This is an idea that I have raised. This would be an extraordinary thing to do, and it needs to be thought through very carefully. On the purchase of other assets, I have absolutely no theological or religious principled objection to our buying non-gilt assets. What I would say to you is there are practical considerations which deserve weight. The main classes of assets in this country are equity and land. This isn't like the United States of America, where there's a wealth of other assets denominated in sterling. There aren't tradable pieces of commercial loans. We are lending against commercial loans, and in my judgment, for what it's worth, lending against commercial loans and buying commercial loans is more or less the same thing in terms of its economic effect and the help that it can provide.
Okay, now what are the other ones? What are the other ones that are not mentioned here that you're potentially looking at? But don't mention.
Well, I think we've mentioned the FLS things. I've mentioned
negative. That's in operation now.
I've in answer to Mr. Ruffley, I talked about possible extensions, which I have aired, which would be quite significant in terms of lending to non-banks or lending via non-banks, and also trying to revive a market in working capital finance where we could once again buy pieces of working capital finance paper, the old bill on London. And I've said that publicly.
Okay, I'm not getting personal, and I'm interested in your personal views, but I'm really interested in what alternatives were on the table when you had this broad discussion. And I'd welcome you sending the committee a list of other items that are not mentioned here.
Well, these were the main items that we discussed.
So
these are the main items that we
reads.
discussed.
That's not how the minute reads. These were the ones, these were some of them, and these were ones with drawbacks, so they're mentioned as though they're already dismissed. And if you've dismissed these, I'm simply asking, what other monetary policy initiatives have you up your sleeve if we have this sad position with growth and we need to get some monetary help?
First of all, I don't believe these are dismissed. When we say we're leaving them on the table and continuing to consider them,
these.
I have mentioned to you this morning negative interest rates. That's a pretty radical idea and not something anyone should clutch onto as the answer to the question of the universe. And in terms of credit supply to the economy, which matters so much given our beaten-up banking system, I have set out, in response to Mr. Ruffley, I have amplified on what is stated very briefly here, and I hope that is helpful to you.
I just have the third question, the last one, which is on paragraph 35. It seemed possible that a further broad-based monetary stimulus would on its own be insufficient. We accept that. The committee also discussed other potential measures that the bank, together with other UK authorities, might deploy. A number of more targeted interventions to boost supply demand in the supply capacity of the economy and to facilitate rebalancing might be entertained. But many of these fell to other UK authorities. Can you list them, these?
Well, the thing that lies within our competence is to try gradually to improve the performance of the banking system, and the FPC is doing that.
Again, Mr. Tucker,
I'm sorry.
This is the minutes of a meeting.
Yes.
And you said there were a number, the minutes say, a number of more targeted interventions, but many of these fell to in partnership. Now, I'm simply asking, could you supply the committee with a list of these other possible interventions that could take place, albeit in partnership with the other UK authorities? And can you also define, when you pass us this note, the identification of the other UK authorities?
Well, the main area is supply-side policies. We do not have a detailed list of that. It's not within our responsibility, and it would actually, I think, be wrong for us to carry around a specific menu. The broad point in economics that we have made is that things that could improve...
Well, with the greatest due respect, your minute says, in that context, the committee also discussed other policy measures that the bank, together... So you discussed them, but you don't have a list of them.
Perhaps we should have included the words in broad terms. I wish following this exchange that we had. If you have taken away from these minutes the idea that there is a...
That you're actually working on something.
Is that there is a specific list of things on the supply side, which of course are the competence of government, there is not.
Okay, well that's very helpful clarification. A lot of clarification today. Got a couple more colleagues who want to come in, but I just want to ask you, not now, but perhaps in writing, if you could set out the extent of your thinking, and it may be only very sketchily developed, on how you would go about putting a floor to negative interest rates.
It's a good question.
That's why we're asking it, and we look forward to your answer. Pat McFadden.
I'd like to return to this issue of the pound and the exchange rate. The new incoming governor of the bank has said that the UK's export performance is the worst in the G20, and that's despite devaluation of about 20% or more in the last 4 or 5 years. We start with you, Mr. Bean. Why do you think the UK's export performance has been so poor relative to other countries, and why have we not seen more benefit to exports from this devaluation?
Okay, I mean there's a box in the inflation report in chapter 2, which I think is quite useful at this point. It's, if you have it,
got it here.
It's on page 24. I mean, chart A just shows the extent of the sterling depreciation, 25%. Since the beginning of the crisis. So, you know, there's a large depreciation, no doubt about that. Firstly, I think it's worth saying that there's two elements which actually work pretty much as we expected. So the behaviour of imports has been in line with past experience. And if you look at chart C, which shows our share of exports in an appropriate global measure of trade, as far as goods are concerned, that share had been falling, and since the depreciation, that's levelled off. And in pretty much
it's levelled off, but it's not.
No, but I mean, remember that this is a share, and the overall market size might be getting bigger. So the puzzle lies in what's happened to exports of services. That's where the big puzzle. And if you notice in that same chart, that was where we had been increasing share during the years leading up to the crisis. And if anything, you might have hoped the depreciation would have allowed that to keep on carrying on. It hasn't. It's flattened off and fallen back. Some of that is down to exports of financial services and is obviously connected with the financial crisis. But there's also a wider weakness in business services more generally. Now, what is not clear to us at the moment is whether we can expect, or to what extent we can expect, that unexpected weakness, particularly in those categories, to come back. Or is it something we've lost permanently? So it's like a permanent adverse shock to our ability as a trading nation. And you might think, well, some of this might be relatively persistent, the bit that's connected with exports of banking services. If that's the case, you might take the view, well, we need an even bigger depreciation to make exports of goods and other services more competitive and to lean even more against imports.
Is that your view?
I'm not convinced that we necessarily need a nominal depreciation to get that. One of the things that Chart A brings out here is the fact that measures of the real exchange rate have been appreciating recently. The one that I look at most often, I regard as the most useful thing to look at, is the yellow line, which is based on relative unit labour costs between countries. Now, you can see that line has come back quite a lot. We've lost about half of the gain that we got. And that reflects the weak productivity performance in the UK. So the crucial question here is, do you think that weak productivity performance is actually something that will solve itself as the economy picks up?
So, in simple terms, you're saying that this line shows that by keeping people in work, we are increasing our unit labour cost and perhaps making life more difficult for ourselves when it comes to exports. Is that what you're...
Well, it means that the competitive advantage to businesses is less than it might otherwise be. That's not to say they should sack everybody, because there's obviously advantages to keeping people in work. It helps to keep demand up. But if, as the economy recovers, businesses find they can utilise their labour more efficiently, you'll find that productivity improving naturally. That's the argument that David was making earlier on this morning. I think the other thing that's worth saying is that it may well take time for exporters to respond to the change in the profitability that the depreciation has allowed. If you're somebody who's thinking about getting into foreign markets,
this depreciation, most of it happened in 2008.
No, but it's not just that. It's also it's also the conditions in the foreign markets themselves. It's not straightforward to suddenly start exporting to China or into bits of the Eurozone that you haven't targeted before. And in an environment where there's a lot of uncertainty, you're probably pretty cautious about some of these things. So it may well be that some of this is it's just taking time to see some of the benefits. And I should say, I was on a visit to the Northwest last week visiting businesses. One business told me that they were consciously switching more of their sourcing to UK suppliers of clothing. This was a mail order business. Another one told me they were onshoring their call centre, which they had previously offshored to India, because it was now cost effective for them to do that. So we do hear stories of the mechanisms working the way they're supposed to. But it's fair to say, we have been disappointed about not getting more of a kick to the recovery from net exports.
Well, that's what I'm...
Yeah, no, absolutely. I mean, there's absolutely no doubt that we've been disappointed relative to our expectations.
So if someone had asked you, 4 or 5 years ago, we're going to have a depreciation in sterling of about 20 to 25% relative to other major currencies, you would have expected more of an effect.
Yes,
than you'd seen.
yes, absolutely.
Does anyone else want to come in on this?
Well, I agree with what Charlie has said. The only thing I would add is quite an important question in the years ahead will be whether exports of financial services increase again. You know, whether we like it or not, this is a significant part of our economy. It's been a significant part of our external trade in the past. My personal expectation, for what it's worth, is as the world heals, assuming it does heal, that exports of financial services will pick up again. Yeah. But I would add that we need our external trade to be more diversified, both geographically, which is the point that Mark has made about the Far East, and Mervyn has made in the past as well, but also in terms of the type of thing that we can no more afford to rely on just exporting financial services than we could 25 years ago rely on just exporting manufacturers.
But even in terms of your point on goods, this chart on page 25 shows a flat picture for the last 6 years.
That's the geographic point.
So, sorry, are you talking about chart C here? Or
yes, chart C.
Yeah, and remember this is just a share of the market.
But it's relative to other currencies that we're talking about. That should have helped us.
Yes, this has helped us. It'd be nice to see this red line going up instead of being flat.
That's what I'm driving at. Now, let me ask you then about the future, if that's the past. In your MPC deliberations, do you take a view on this currency question? Is it a central part of your thinking? Is there a MPC view on the currency and where you'd like to see it go?
No, I mean the exchange rate is obviously important to the outlook for both inflation and output. When the currency is weaker, that tends to push up import prices, so it raises the inflation profile. Has a two-edged impact on activity. On the one hand, the higher import prices reduce the real incomes of households, so that tends to dampen consumer spending. But on the other hand, we hope that it has some beneficial effect on exports, and we still think that net the effect is probably expansionary from an exchange rate depreciation. So where sterling is and where it's likely to go is very important to us forming a judgment
what
on
I'm trying to tease out of you is
I
whether
know.
you have a desired direction of travel.
No, absolutely not. I mean, the markets will take the exchange rate where it will. We do look at issues like, do we think the risk to sterling might be in one direction or another? So, for instance, if we're running a current account deficit, as we were for the decade before the financial crisis, we did repeatedly say that at some stage we thought there would need to be an exchange rate depreciation to rebalance the economy and eliminate the current account deficit.
Rebalancing hasn't happened.
But there has been some rebalancing, but not anywhere as much as we would like to have seen.
Professor Miles, you voted with the Governor to have more QE at the last MPC meeting. When the minutes were published, the markets were somewhat spooked or surprised at least by this division in the MPC on this issue, and one of the quick consequences of that was downward pressure on the pound. Did you regard that as a fairly benign, if not desirable consequence to that? Was that part of your thinking?
Well, I'm not sure about benign, and I'm not sure how long-lasting it will be. We have very few reliable models of the exchange rate, so it wasn't certainly part of any strategy to try and get the exchange rate to move. I think the exchange rate is pretty much unpredictable, and when we produce our own forecasts, we use as the least bad forecast simply what the market expects the exchange rate to be. That always turns out to be wrong. but it's probably the least bad forecast. So I don't think there was any expectation that there would be some reliable movement in response to the way the voting went. I mean, I hadn't changed my vote, as you will know. I mean, I have taken the view for quite a long while that stronger growth in the UK would be very welcome. I think we all believe that, but also consistent with inflation gradually moving back to the target level. And I felt that having a slightly more expansionary monetary policy would make that growth more likely, and partly for the reason that Charlie mentioned a moment ago, which is the likelihood that some part of poor productivity just reflects weak growth in itself. If you believe that, as I do, that would mean that stronger growth would improve productivity, would be consistent with inflation pressures, probably no higher, and therefore would be a welcome thing. So that was my thinking behind continuing to vote for a more expansionary policy.
Well, let me just finish with this. I'm conscious of time. Under the heading, the Bank of England does what it does, not what it says. James McIntosh wrote in the FT the other day, perhaps Sir Mervyn's vote, and by implication yours, Professor Miles, was merely part of his ongoing effort to talk down the pound. If so, it worked.
Well, that wasn't my motivation for voting the way I voted. As you'll know, I voted this way for some months now. It was based on an assessment of the likelihood of growth falling in different ranges. My assessment that stronger growth would more likely come if monetary policy was more expansionary. I also take the view that quantitative easing, more asset purchases are likely to increase the pace of growth in the UK, not particularly through the exchange rate, which I think is highly unpredictable, but through some of the other channels we were talking about earlier. We talked about the search for yield, making investments in corporate bonds, in equities more attractive, and that having a positive impact on demand.
Mr. Tucker, you earlier said that this was the kind of road to hell, this competitive currency devaluation.
Not what
the G20 finance ministers issued a very pious statement saying this would all be bad, but talk's cheap, isn't it? And the actions of us here and other states will speak louder than G20 finance statements.
I think I've used the word sound money 3 times this morning. I don't believe for a second that David or Mervyn's or Paul Fisher's vote was motivated by trying to manipulate currency, and if they try to, I think they'd fail. Monetary policy has an effect on currencies. Actually, we need to stick to explaining what we do in terms of the mainstream effects and be careful about what we say. It is very easy to be, at this point of an economic cycle, where, big picture, I think we have to be patient. It is very important kind of not to lose our nerve and to talk in ways where we can be misunderstood. Because actually it's not just actions that make a difference. In the short term, talk can make a difference too. And I think the G20 and the G7 have sensibly been trying to row back their talk and to bring it into line with the actions, and I welcome that.
Very quickly bringing us back to an earlier point that was made about labour hoarding. Mr. McCafferty, do you think there is a lot of labour hoarding going on, and do you think that's retarding recovery?
First say, Chairman, that I'm not sure I like the term labour hoarding because it makes it sound like it's a very negative concept. What I said in my speech was that I do believe that the nature of the way in which employers and employees work together within the labour market has changed, and that one of the values of that employers are increasingly recognising is of the longevity of some of their employees, that they gain productivity and they gain skills through working with individual companies over a longer time frame, which makes employers reluctant to lose those employees simply because short-term demand conditions are less than they would like, or certainly deficient in this case. So from that point of view, I think if you want to call it labour hoarding, I think there is some degree of labour hoarding. It is clear from the statistics that employment growth is relatively strong at this stage in the cycle, whereas output growth is particularly weak. By definition, therefore, we have to have some form of labour hoarding in that sense. I think it can be explained, as I say, because I think there are firm-specific skills that employees can gain which are increasingly important in maintaining competitiveness for many firms, which leads them to be reluctant to lose those employees. Firms are able to maintain their labour force in this particular recession, which I think is a contrast to previous recessions, because of the less difficult financial conditions that they face, the very low interest rates, the use of QE, the fact that firms themselves went into this downturn in a better financial position than previously, means that firms are able to maintain employment in a way that they weren't in the 80s and the 90s.
But you're portraying it as a good thing. They're hanging on to people who they're going to need when the upswing comes, and therefore you're partly answering Mr. Bean's question about the yellow line in Chart A,
yes,
page 24, by saying you're optimistic that that's going to go in the right direction.
Yes, I think that as the recovery gains some strength, that we will see productivity naturally recover as people work more intensively than they're having to do so currently.
Okay, Jesse Norman.
Thank you, Mr. Chairman. Can I ask you, Mr. Tucker, you've said you've raised the very interesting and controversial idea of negative interest rates. You're going to write to us kindly about how a floor could be set as such. Could you also include in that any thinking you've done on current mechanisms for how it would be implemented? I'm grateful. When you remarked about the importance of the bank staying out of the supply side of the economy, of course, I hope it wouldn't be facetious to point out that you've got an extraordinarily large influence over one aspect of the supply side, which is the supply of money. And it would be nice to think that as the bank takes over more responsibility, proper responsibility of the banking system, it could be gently guiding the large banks towards a proper recognition of the function of banks, which is to supply capital, in particular working capital, to industry, and to get out of the business of principal trading and punting their own treasury operation. I hope you'll pass that message on in the supervisory role that you increasingly exercise.
I think that the first step is to gradually restore these banks to health. Talked about that on other occasions. The other thing I would say is it's not just a matter of exhortation. The changes made in the regulatory regime in Basel, which for understandable reasons, don't get a huge amount of prominence here, will tend to tilt the allocation of capital away from trading towards real economy provision of credit, and that process isn't yet finished. If you said to me how much, I don't know, because that work is still ongoing. But this crisis was a long time in the making, and some of the details of regulation can affect incentives in the financial sector in a very potent way. But we are trying to design an international regulatory framework, and I know that Mark talked about this when he was here, that both underpins soundness and unwinds some rather unfortunate incentives.
Thank you. Mr. Bean, you'll recall that European Monetary Union was dogged from the outset by an inability to maintain countries within the framework of the spending and growth requirements set by the European Commission. And you've just described very eloquently why a banking union required to make European Monetary Union work effectively is going to take, at the very least, many more years to implement. Would it not be your view that actually these should have been foreseeable in advance, and therefore the implementation of EMU has been a fiasco?
Well, I think it's fair to say that there were plenty of commentators, academics and the like who did suggest when monetary union was first mooted that it needed to be associated with a degree of fiscal union, so forth. Now, the route chosen to deal with the fiscal issues was, as you say, the Stability and Growth Pact, which turned out not to have teeth. Also, I think insufficient attention was given to the question of how you deal with heterogeneous developments in different parts of the community and the problems that that might lead to. I don't think people did realise, though, that actually one of the consequences of monetary union was going to be to encourage capital flows into the periphery and the build-up of financial imbalances there. It obviously connected with the wider developments in global financial markets, but that exposed, I think, the issues in the structure of financial markets, banking union territory, in a way that I think it's fair to say most people hadn't really anticipated, although with hindsight you can see the issues. But certainly,
well, Greek interest rates falling as quickly as they did might have encouraged.
Absolutely. You know, I mean, there were people who identified that would have some consequences, but I don't think anybody can really claim to have said, "Oh, this will lead to build-up of financial imbalances, which will eventually unwind in an unhappy way."
I mean, because I'm sweeping up a bunch of things, I want to keep moving, if I may, and I take your point. What's your central guess, Mr. Bean, for how long a proper banking system will take to put into place? Banking union, if you like.
Well, it depends whether you want all of my 5 items.
Well, you have to have 5 because you said they're necessary. So
well, I said for a durable one.
Well, let's have one that works. How about that? How long will that take?
Well, I suspect you will have the supervisory mechanism in operation by the beginning of next year. I mean, that's clearly the roadmap that our European partners
but all
have out for themselves. The time frame for the resolution...
I hope the directive is done before the summer, and then they've said that they will announce their plans for a banking union resolution authority before the summer. I think the other thing that's worth saying about this is that once the ECB have got responsibility for supervision, without the other pieces that Charlie described being in place, they have a hell of an incentive to push for further steps. You know, one of the great lessons for supervisors in this country is being a supervisor without an adequate resolution regime is a pretty stupid place to be. I think that we will find over time that the ECB end up being a voice to push along the line that Charlie has described. Whether they'll succeed,
right? But I mean, is it 5 years to hit all these 5? Is it longer? How long? I mean, I see people say it's a decade. I mean, what's your best guess?
I don't think you can necessarily easily set a timeline, because the last 2 steps are connected with the politics of this and whether there is the will for the North to provide the backstop.
Goes back to Ms. Ledstam's question.
Yeah. No, I'm fully aware of that.
No, but we think you're better equipped to make judgments on that than us.
Okay. So it's not in your view at the moment. There's no guarantee it'll happen at all. Is the point you're really making? Okay. What about? I mean, nothing's changed in the eurozone, right? Economically, I mean, or very little has changed economically. That is to say, the European Central Bank is now supplying essentially unlimited liquidity, but the fundamental economics of productivity imbalances has not really, I think I'm right in saying, changed. What risk do you think, any of the panel really, but I suppose in particular Mr. Bean, there is at the moment to a balance of payments crisis within the eurozone?
Within the eurozone?
Well, either within or without.
I mean, firstly, I think there has been some improvement relative to where we were in the middle of last year, and in particular the ECB's declaration it was willing to undertake these so-called outright monetary transactions, buying the short-term debt of periphery countries in receipt of a support programme.
But how has that actually improved the fundamental economics, the productivity imbalance?
Okay, I'm going to work through. Okay. So there certainly has been an improvement there, which has brought down yields very significantly for countries like Italy and Spain. That means it's easier for them to finance their their fiscal deficits. And that's a real improvement. You shouldn't underestimate that. It's also played in more generally to the improvement in financial markets around the world, a sense that they're heading in the right direction. Where you're absolutely right that there is still a long way to go is in the underlying real problems of those countries in terms of indebtedness and competitiveness. And I would emphasize the competitiveness part, because countries like Italy, Greece, Spain, they lost quite a lot of competitiveness relative to Germany in the first years of monetary union, and they've now got to get that back, increase net exports in the way we want to, in the way we were discussing earlier. But of course they can't do that by changing the exchange rate. They have to do it either by changing pay levels or somehow bringing about a big improvement in productivity. So these are big challenges they still face, and there's a long way to go. I think it's fair to say that, you know, that some of them are making significant steps, though. And if you look at a country like Spain, its trade performance has actually been really quite strong, despite not having the access to the exchange rate.
Do anyone want to add anything to that?
I'm sorry.
I didn't know if anyone wanted to add anything. Okay, final question then. Thank you for that.
You were being asked whether you wanted to add anything, Professor Miles.
I would say one thing which I'm sure is a minority view, and actually it's a view that doesn't affect my thoughts about UK monetary policy. I think the view that you can only make a monetary union work with fiscal union is profoundly wrong, is my own assessment. I mean, I think the reason why there was such a problem in the Eurozone was that there wasn't a recognition early on that bonds issued by different entities in the same currency actually had very different risks. People took the view that as long as a bond was issued in the same currency by a government that was in the Eurozone, it had the same risk as the least risky government in the Eurozone. And that's a mistake which I suspect people will not make again, at least for a very long time.
So the challenge is to make no bailout credible.
Yeah.
Yes.
I mean, in a strict sense, David is right, but you do then need to make the no bailout credible. If it's not credible, then you need mechanisms for transfers.
You want to say something else, Professor Miles?
No. That was all.
I mean, Dr. Carney has noted what he called an underlying sickness, that is a balance of payments crisis within the currency area. Do you think that's a mistake?
No, this...
Well, that's the imbalance.
That's the imbalances that exist at the moment.
Well, that was the question I originally asked.
And my remarks about competitiveness were precisely a response to that.
So you don't think there's a likelihood of having a balance of payments crisis within the currency area?
There is one within it.
Well, you could say that, yes, there is one.
There's
Okay, so there is one.
Yeah, there is one, and it manifests itself as vast balances in the so-called target system, where the German banks are effectively lending money via the Bundesbank and the Netherlands Bank to the southern countries.
Okay, great. So we're where I think we should be, which is we've got a balance of payments crisis in the Eurozone. And that was my original question. And
Yes.
we're now 5 minutes later there. Good. Well, I agree. Can I ask another question, which is, what about, you didn't actually answer the question that was put to you, Mr. Tucker, about a currency war. What is the actual risk of having a currency war at the moment? It's low, medium, high.
I think if everybody conducts themselves in the broad way I've described, I think it is low.
But what if they don't? What is
Well, I think they have no incentive. They've all got domestic price stability objectives. I don't see any evidence that any of them are departing from trying to pursue their own domestic mandates. That is not a recipe for a currency war. Where there is a degree of tension is between the big G7 countries and other countries who link themselves typically to the dollar, and they become concerned about importing US monetary policy and the capital flows that go with that. And as those economies become bigger, that does pose questions about the design of the international monetary system, but that is quite separate from questions of currency war amongst the big countries, which I don't see that need happen. People would have to try quite hard to make mistakes.
You're saying not only did it need not happen, but you don't see any signs of it actually happening now.
If you go back a few weeks, I certainly saw signs that the markets were worried about it. I think the officials of the G7 and G20 have responded in a sensible way.
Thank you very much. Thank you.
Been extremely helpful this morning, which has now become this afternoon. Thank you very much for coming in. We've picked up a great deal about your messaging, about some key facts in a number of areas. Clarity has been brought to policy, and we'll be following up a number of points that you've raised in writing. Thank you very much indeed. Order.